Understanding the triggers that may attract the attention of the IRS is critical for taxpayers, especially business owners and investors. Awareness and preparation can minimize the risk of audits and ensure compliance with tax regulations. Below are 8 key red flags outlined by the FitBiz CPA group that taxpayers should keep in mind. Number 1, reporting discrepancies. One of the most important common triggers for an IRS audit is mismatched income reporting. The IRS cross-references tax filings with third-party reports from banks, employers, and other institutions. Any discrepancies between reported income and these official records can prompt scrutiny for taxpayers. It's essential, guys, to double down and double check the accuracy and verify the accuracy from your W-2s, 1099s, and bank statements. Number 2, large and unusual deductions. Claiming deductions significantly higher than industry standards or disproportionate to income can raise red flags. For example, taking home office deductions to qualify for your home office. Listen, there's a time and place for that, but illegally taking a home office deduction when you don't have a home office is going to trigger a red flag. Business travel expenses, same thing. If you take vacations and write that off as an ordinary and necessary business expense, you're going to be hit with an audit. Number 3, real estate professional status. Taxpayers who take this come under heightened scrutiny under the IRS. So the IRS has a requirement of hitting 750 hours, and we've seen clients who cannot prove 750 hours, cannot prove material participation, don't have the documentation or activity logs, and cannot substantiate real estate professional status. Don't do it. Just don't do it. Number 4, errors in reporting losses. When rental property income and losses are reported due to depreciation on the Schedule E, sometimes we've seen certain clients not report certain income, certain losses, and not follow the passive activity loss rules per the IRS. Number 5, high charitable deductions. Donating to charity is a noble act, but claims must align with income levels. Excessive or unsubstantiated charitable deductions may trigger audits. Taxpayers should work with their professional and maintain records and acknowledgement letters from charitable organizations, ensuring deductions comply with your IRS guidelines. Number 6, most important piece of the puzzle, unreported foreign assets. The authorities require taxpayers to report foreign financial accounts on something called the FBAR, Foreign Bank Account Report, or the F114. If you don't properly report these bank account balances, you're gonna get hit with a IRS red flag or an audit. Number 7, negligent or incomplete record keeping. Poor documentation is a common reason audits escalate. Taxpayers are advised to maintain organized, detailed records of income, expenses, and deductions. Use digital tools for tracking and storing receipts, invoices, and other relevant documents. Our favorite tool is QuickBooks Online or Xero. These are great digital tools to keep track of your income and expenses. Number 8, misclassification of employees. I can't tell you how many times I've seen employees being classified as 1099s. Businesses often misclassify employees as independent contractors to avoid payroll taxes. If this practice is discovered, it can lead to audits, interest, and penalties. Correct and essential reporting must be completed in time. Make sure to consult with your tax professional. Mitigating the risk of an IRS audit to reduce the likelihood of an audit, make sure you will file accurately. Ensure all figures are correct and aligned with third-party records. Document everything and keep meticulous records verifiable by third parties, and make sure you have records of your deductions and income as well. Seek professional advice. That's what we tell our clients all the time. Don't do it yourself. This is not DIY, guys. You need a CPA, a tax advisor, who can help identify potential risks and optimize your filings. By proactively addressing these red flags, taxpayers can reduce their risk and maintain compliance with the IRS rules in 2025.